A U.S. senator expressed worry on Sunday that the Federal Reserve was going to tip the world's largest economy into recession.
The Fed has finally admitted that a recession is quite possible. And although many experts have already declared a recession in the US, the Fed still refuses to admit it entirely. Fed Chair Jerome Powell is tasked with a very difficult job of keeping inflation down, but at the same time not crashing the entire economy. However, despite the interest rate hikes, inflation continues to play around the 8% mark. The Fed is threading a very dangerous needle that could change the lives of American consumers over the next few years. Stick around as we talk more about this inflation and the Fed's policies against it that could drive the economy into a collapse. Thanks for all the support you've shown our channel. Let's dive right into the video. Even though the Fed has increased rates and removed a vital part of the economy, Fed Chair Jerome Powell stated last March that a recession is improbable. However, in the month of June, Powell expressed his belief that a recession is possible but unlikely. Because of this, many are wondering why his opinion has shifted. It was recently reported that real GDP growth slowed to an annual pace of just 0.6% in Q2 2022. Since the first quarter decline was 1.6%, this indicates the economy is contracting and is in a recession. But according to Jerome Powell, the economy is not currently experiencing a recession. It almost looks as though he defines recessions in his own unique way. This is most likely what will occur if you are unable to perform adequately in your job. But in the month of August, he warned that trouble was on the way. What could that possibly suggest? There has been a general decline in economic activity, a collapse in the financial markets and stock markets, and numerous corporate bankruptcies. Jerome Powell, meanwhile, continues to resist using the term recession. He is open to using any other term, but not that one. Allow me to explain the meaning of some pain. If the cost of capital rises, then businesses will have to close their doors and people would lose their jobs. Rising interest rates mean that borrowing costs rise, making it harder for businesses to continue their rapid expansion. It can be challenging for some people to grasp the concept that money won't necessarily alleviate all of the challenges their business may face. If you continue to put money into a company that is losing money, it is possible for the company to endure, but the amount of time that you keep putting money into it is irrelevant. If it can't turn a profit, it will fail as soon as funding is cut off. Have you ever observed the employees at a restaurant? Typically, the cooking staff numbers are between 8 and 10. If we multiply the number of employees there, they won't create twice as much food, and their efficiency would probably decline because there isn't enough room for 8 people to work efficiently. The law of diminishing returns states that adding more of something always results in less of an effect. Nevertheless, you are still obligated to pay each and every one of your employees. This isn't an issue as long as there is unlimited funding available. But problems arise when this source of funding dries up. You have no choice but to reduce the size of your crew and do everything in your power to maximize productivity with just a fraction of your usual amount of employees. This explains why some corporations, like PayPal, have started laying off workers as recently as the month of May. The cryptocurrency exchange Coinbase has announced it will be laying off 18% of its staff. Tesla has started laying off 10% of its personnel, and former workers have confirmed that they had been terminated from their positions. Although the Fed is attempting to reassure us that everything is going well and that we shouldn't worry, the truth is completely different. More specifically, investor Ray Dalio predicts disaster for the United States any day now. When this debt catastrophe finally hits, it's going to be like nothing the world has witnessed before. Why will it not simply trigger a market collapse, but may also force the US economy to crumble? How much higher do interest rates have to go before the Fed succeeds in taming inflation? And how exactly can one get ready for the largest economic collapse in US history? Stick around as we discover the answers to these questions. The primary responsibility of the Federal Reserve is to safeguard the dollar's purchasing power, maintain public confidence in the dollar, and guarantee that your dollars will retain their purchasing power into the foreseeable future. Therefore, when inflation is so close to reaching double digits, it is abundantly evident that the Federal Reserve is unable to do the most crucial task that it has. But the Fed can't be held responsible all the time. The government also bears some responsibility. After all, they appoint the Fed chairman. Although debt is easy money, it does not come without a price. It is expected that any borrowed funds would be paid back with interest. That is the way the capitalist system functions. As soon as the government starts printing too much money in order to satisfy their financial obligations, the value of the dollar will free fall. Consider a world where the total economy consists of 5 commodities and $5. Each item in this fictitious scenario will be priced at $1. If we add 5 more dollars into the economy, the money will increase to $10 while still having the same amount of commodities, which will lead the prices to increase. Whatever the case may be, this is the inevitable result of pumping too much money into the economy. Rather than attempting to address the issue by restricting the flow of money, the Federal Reserve is stating that inflation is driven by scarcity in the energy sector as well as issues with supply chain logistics. Sure, these things are playing a role in driving up prices, but that doesn't alter the reality that there is simply too much money floating around. Former Fed Chairman Arthur Burns said the same thing about energy and food during his term in the 1970s. However, later on, he made an overnight increase in the rates that brought them up to above 12% late in 1974. This immediately halved inflation, which was excellent news, but also caused a recession as a result of the abrupt decrease in money streaming into the economy, which caused the unemployment level to soar from 5% to almost 9%. Burns acted in a panic and decreased interest rates, which led to a return of inflation rather than preserving the rates high enough for an extremely extended period of time. When Paul Volcker was elected to lead the Federal Reserve in 1979, inflation finally began to fall. He eventually had the rates at 19%, where they stayed for a while. Even though he was unpopular and many despised him, he managed to leave the office with inflation hovering around 3%. It appears that the same pattern is repeating itself since the Fed again ignored warnings of inflation last year and did not raise interest rates. As of late, the government has been unable to raise interest rates sufficiently, claiming that rising global energy costs are to blame. No matter how much they deny it, the economy is going to dip into a recession. Let's face it, increasing the rates will hurt. But you know what hurts worse? Watching your investments' worth disappear. Ray Dalio claims that the downfall is inevitable. Once an economy reaches its pinnacle, the whole thing collapses under its own debt. On the other hand, one person's debt might become another person's financial asset and can even be considered an asset that generates additional income. A growth in US debt means that whoever holds that debt benefits financially. As interest payments on that debt accumulate, it becomes increasingly difficult to make minimum payments each month. Consider taking out a mortgage. The monthly payment of $1,000 is manageable, and the debt is manageable because it is spread out over a few years. Problems arise though when you take out loans to finance things like a car, credit cards, a vacation, or home improvements, but your earnings don't increase proportionately. Therefore, you must eventually cut back on your expenditures or risk filing for bankruptcy. The issue is that when governments generate money to increase their riches, very few people pay any consideration to the origin of that money. Politically speaking, it is simpler because everyone received their paychecks and no one's wealth was taken by the government. Moreover, discussions regarding expenditure are common, but sources of funding are rarely brought up. The stimulus checks were a source of concern for everyone, but nobody bothered with finding out where the money would be obtained from. By providing support to Ukraine at this time, the United States is inadvertently starting a conflict with Russia. Where exactly does all of this money come from? Who or what is providing the funding? It is an endless list. Then we scratch our heads and ask why there is such a high level of inflation. Simple economic principles such as supply and demand are impossible to fool. We understand that if interest rates are raised, earnings would fall, but excessive inflation will also reduce consumer purchasing power, so regular consumers will suffer anyway. The only distinction is that people who have saved their money won't endure long-term hardship. At some point in the not-too-distant future, the Federal Reserve will be forced to recognize that they have to raise interest rates to such a high level and keep them there for such a prolonged period of time that it will lead to a form of stagflation that will persist for a couple of years. We've previously discussed several strategies for surviving inflation, but we will hear some of Ray Dalio's. Invest in a wide variety of assets, from digital currency like Bitcoin to precious metals like gold, as recommended by Dalio. Determine how long you can make it without a job. It is in your best interest to learn about the direst circumstance possible and make preparations to deal with it. Nothing can be done once stagflation sets in. Therefore, it's best to be ready ahead of time. What are your thoughts on the economic climate in the US? How long do you believe this recession will last? Give us your insights on this in the comment section down below. If you enjoyed this video, give us a like and subscribe, and we'll catch you on the next one.